This is King World News. I'm Eric King, and you are about to hear a very interesting interview with Bob Prechter from Elliott Wave International that investors, traders, and those concerned about the social impacts of this cycle will enjoy. Remember to go to our homepage at www.kingworldnews.com for more interviews, where this week we also have interviews with Peter Schiff from Euro Pacific Capital, as well as Jeff Burns, CEO of Pan American Silver. Joining us now is Bob Prechter, founder, president, and CEO of Elliott Wave International. Bob, I want to talk to you about so many things today: the stock market, the U.S. dollar, the psychology of herding, and more, but in particular, socionomics today and how it relates to investing, so both traders and investors can gain something here today. What exactly is socionomics for the listeners? Because this first reached a national audience in your 1985 cover article in Barron's, correct?
Yep. Well, in a nutshell, most people think that outside events such as economic numbers, political plans, and events, and so on, buffet social mood and make people feel a certain way. But all the studies that I've done, all of the watching of the market I've done shows that there is a structure to the market. It seems to be internally regulated, and that tells me that social mood is not being buffeted around randomly by news. It's the way human beings share mood in society, and those moods in turn have consequences. When the mood gets more and more positive year after year, you tend to see more peace treaties, you tend to see an expanding economy and all the things that come with optimism. And on the downside, people pull in their horns, they get more defensive, they get fearful, they get angry, and you see all the results of that. So social mood is not a result, but a cause of the history that we see every single day in the newspaper.
Isn't the most sensitive register of socionomics the stock market? And you just mentioned there about military things briefly, but I think we have more terrorist attacks, do we not, when the Pakistani stock market is dipping? Is that correct?
Well, one of the things that we said after the top in 2000 was, look out, because the lower we go, there's going to be more risk of social unrest and events. And we ended up being attacked for the first time on our soil. And then at the bottom of that wave in March 2003, we went to war. So those are typical results of a downtrend, and we're in a bigger one now.
The new science of socionomics, and we'll just cover this briefly, but it takes hundreds of popular notions about mass psychology, culture, the stock market, et cetera, and sort of stands them on their head, does it not, Bob?
Yeah, it flips around the causality. We've seen correlations between everything from expansion and contraction in the economy to whether or not an incumbent will get reelected in a presidential campaign, to the number of times that countries will test nuclear arms, all sorts of things, and of course fads and fashions, and even such things as when people decide to have children. We went back as far as the data can take us, which is about to 1920, and we see that conception rates in the United States pretty much go up and down with the advanced decline line in the stock market. I don't think anyone would argue that one causes the other, although that's the usual default for most people who try to make conclusions about these things. We say social mood is governing on both at the same time.
From a piece you put out with Wayne Parker, quote, socionomics challenges not just the validity of fundamental analysis valuation, but also its underlying idea of inevitable reversion to the mean. We observe that every proposed stock price mean is changing or arbitrary, being a function of the time period chosen. So stock prices have nothing constant to which to revert. Can you explain that a little bit more?
Yeah, absolutely. There's been so much talk about the financial markets acting like economic markets, where there's some sort of supply and demand equilibrium point where everyone's satisfied with the price and really doesn't fluctuate very much after it's reached. Financial markets are, to any casual observer, in my view, demonstrably different, because valuations fly all over the place. Even relative valuations fly all over the place. They fly all over the place not only every year and every 10 years, but also every month, every week, every day, and minute after minute all during the day. So something very, very different is going on. And what we argue in the paper is that when people are going to the shoe store or the grocery store, they're making choices consciously because they know what their needs and desires are. In finance, everything is different because there are no suppliers and consumers. There are only investors, and they all have the same desire, which is to make money. So they look around because they have no certainty about that. They don't know what their own use of a stock share is. So they decide, well, someone else, it all depends on someone else. And that gives them a context of extreme uncertainty, tremendous lack of knowledge. And when people are stuck in that kind of position, they don't reason their way out. They herd. They look around at their fellows and they do what the others do. And that's why markets are so impulsive and can get way overvalued and way undervalued and have trends along the way that persist.
As your socionomic theory of finance, or STF, opposes the efficient market hypothesis, or EMH, it is replaced, as you mentioned briefly, by that law of patterned herding, or LPH. This is a very important concept for people to understand, correct?
I hope so. We talked about the herding portion. The pattern portion we haven't talked about, but the approach to market analysis that I've used all these years, of course, is called the Wave Principle, which R.N. Elliott figured out in the 1930s, and I think it is an accurate description of the way markets move. So I don't think herding is random, which wouldn't really make any sense. I don't think herding is rational. That wouldn't make any sense either, or conscious. The alternative is that it's unconscious, and the unconscious mind operates by rules, and those rules result in patterns. So when people cooperate in their moods and they act accordingly, you can see the patterns trace out in the history of price change in the stock market averages, S&P and the Dow.
Let's talk about the stock market now, because you made the case in a Bloomberg interview from August of last year that declining volume was occurring during the rally and that it was representative of a bear market rally. And I think at that time the Dow was around 11,000 and the rally rolled over and the stock market continued its precipitous decline. Right now we're having this declining volume accompany this rally, are we not, Bob?
Not only is it declining, but it's probably the most persistent decline in volume I've ever seen. From March to the present, it's been down, down, down all the way.
The latest Investors Intelligence survey shows there are roughly 32% more bulls than bears, which is an extreme, with bears falling under 20%. Isn't that another concern for the market here? Isn't that also a sign of herding to some degree?
Oh, yeah. All the latest polls show that in the month of August, it was like a light switch got flipped, and everybody went from being afraid of the downside to being positive about the upside. Economists all turned bullish and said the economy is either bottoming here in the second quarter or is bottoming in the third quarter. We had the Fed, essentially the head of the Fed, say, we're out of the woods, we avoided the problem, our remedies worked. And these kind of news events are classic to occur after the market has gone way up a lot, because they're the rationalization of the optimistic feelings that the rally was based on in the first place. In fact, when this rally started, we called for a rally in late February, saying it should bottom in the 600s for the S&P. We got down there on the 6th of March and the 9th of March. And after that low, we said, okay, now get ready, because what does a rally mean? It means an increase in optimism. And so you're going to see economists call the end of the recession, you're going to see the Fed say that they were successful, and you're going to see people claiming a new bull market has begun. These are normal rationalizations for a bullish mood. So get ready, because when we're ready to short the market again, that's the environment we'll be in.
If we look back a decade ago, the stock market was soaring in 1999 and people thought peace in the Middle East was at hand. Then you had despair by the end of 2002, right, with the stock market decline. And then you had euphoria from the housing and stock market boom for 05, 6, and 7. And when you contrast that to today, of course, the world is a much different place. We have troops in Afghanistan and Iraq, and there's instability and questions about an attack on Iran, and the stock market tumbled and so on. Why do trends in human society sometimes change so suddenly?
Because the trends in social mood change. Everything is generally considered fine as long as social mood is improving. For example, it was a long bull market from 1974/1982 all the way to the peak in 2000/2007. And during much of that time, people were more optimistic than pessimistic. Every now and then there was a setback like the 87 crash or the 2000 to 2002 setback. And there was a little concern, almost none on the second one. But every time that happened, you would see some changes in the fundamental events. That 87 crash led to a recession in 1990. That was a long corrective process under the Wave Principle model that ended in 1990 and gave us a recession. And the drop in 2000 to 2002 gave us a recession and a war. And now the recent drop has given us a credit crisis and, an increase in troop allocations to Afghanistan and other things that people would not have expected, particularly from this president. But we should be looking for more of this kind of thing.
From a recent article of yours, Bob, if only to confirm the socionomic causality at work, an economist quoted in the article above me